Welcome to Section 3, the expenditure approach to calculating GDP. Another way to calculate GDP is by adding up aggregate spending. Aggregate means all together. So we add up aggregate spending on all domestically produced final goods and services. That is, GDP can be measured by the flow of funds into firms. Like the method that estimates GDP as the value of domestic production of final goods and services, this measurement must be carried out in a way that avoids double counting. Returning to our steel and auto example, we don't want to count both consumer spending on a car and the auto producer spending on steel. If we counted both, we would be counting the steel embodied in the car twice. We solved this problem by counting only the value of sales to final buyers, such as consumers, firms that purchase investment goods, the government, or foreign buyers. In other words, in order to avoid the double counting of spending, we omit sales of inputs from one business to another when estimating GDP using spending data. So in our example, we only count the aggregate spending on final goods and services, the purchase of the finished car, which is $21,500. As we've already learned, the expenditure approach adds together aggregate spending by four groups in the economy. So, who is doing the spending? If we look at the market for goods and services, we see that one source of sales revenue for firms is consumer spending. Consumer spending is denoted by the letter C. Consumer spending is also the largest portion of GDP that uses the expenditure approach. In fact, consumers make up 70% of all spending in the economy. When firms invest in the future growth of their own businesses, like through the purchases of new capital or technology, that spending is included in GDP. That is, an auto company's purchase of steel to make a car isn't considered part of their final spending, but the company's purchase of new machinery for its factory is considered part of final spending. What's the difference? Well, steel is an input, an intermediate good that gets used up in the production process, while the machinery will last for a number of production cycles. Since purchases of capital goods that last for many production cycles aren't closely tied to current production costs, they are considered a purchase of final goods by a firm. We denote these purchases of capital goods by firms with an I. The I stands for investment. When firms produce goods and add them to their inventory, those increases in inventories are added to GDP because it's an investment in future sales. But when goods are released for sale from inventory, the value of those goods is subtracted from GDP. When the government purchases goods and services, either for their own use or for distribution to government institutions like schools or the military, this is counted as spending on final goods in the expenditure approach to calculating GDP. This sector is denoted as G for government. Keep in mind that government transfer payments, we learned about those earlier, they're not counted in this method of calculating GDP because there's no goods or services being purchased, just money being transferred. The final spending sector that we monitor when using the expenditure approach is the international market. This is where foreign buyers purchase domestic goods, and we buy goods from other countries. In the international market, you have a domestic producer, say the US, who makes cars. And you have a foreign buyer, say China, who will be purchasing them. The domestic producers sell their goods to the foreign buyers. The country that made and sold the good calls that an export, and that adds value to their GDP. The country that buys the good calls it an import and subtracts its value from their GDP. Net exports is symbolized as X minus M, or sometimes as X sub M. So, when calculating GDP using the expenditure approach, you will add together the spending of consumers, investment by firms, government purchases of goods and services, and exports minus imports. So, let's have a little sing-along to help us remember the equation for GDP. It's to the tune of Old MacDonald Had a Farm. Are you ready to sing with me? To measure the economy, add CIGXN. Each letter is a spending group, CIGXN. When consumers spend and when firms invest, governments, foreign trade, add it up and you'll get a country's productivity. CIGXN. Good job, you sounded great. All right, let's do a practice problem together. Here's a record of spending for an economy over 1 year. What is the value of GDP if we use the expenditure approach to calculate it? Well, we can see that there's $500 in consumer spending, and there's $200 in investment by firms. Then we have government purchases. Both state, local, and federal government purchases are counted, so added up, that's 300. Then we have exports, but we need to subtract our imports, so 10 minus 15 is -5. If we sum all of that information up, we get $995, and that is GDP for this economy. That's it for section 3. I'll see you in just a bit.